Fed again raised interest rates today and signaled they aren't done hiking rates yet. Let's put it into perspective with economist Altman, who joins us live here on Fox 5. Good to see you again.
Good to see you too, Jim. How are you?
We're well. We're following this just like everybody else. And, we saw this 0.25% interest rate hike, however you want to classify it as. Are we surprised at this number? Because it is smaller compared to some of the other ones we've seen.
Well, this was what the Fed had been telegraphing before the banking crisis that broke out a couple of weeks ago, and this is what they ended up doing. And it's really a clear signal that they believe they can separate their fight against inflation from the support they need to give to the banking system along with the Treasury Department to ensure that this crisis doesn't get contagious.
A lot of people had wondered if the failure of Signature and SVB banks last week would change any of the calculus that went into this. But it seems like all indications were this was where these rate hikes were going to go, considering that inflation has come down. It's not gone, but it has come down a bit.
It has come down a bit. Chairman Powell acknowledged that today, but they're continuing with the policy that they already had in place, which doesn't just mean raising short-term interest rates, but they're also selling off more assets on their balance sheet, and that's going to tighten credit as well.
You know, when we look at the last time the cost to borrow money was this high, you would go back to 2007, which obviously was about a year or so before we saw the major issues across the economy, the Great Recession underway. Are you seeing any parallels, or is this a much different time?
This is a different time from the perspective of the financial system. The financial system is much stronger than it was then. We don't have the huge amounts of leverage and indebtedness that really plagued the financial system last time. But it does still feel very tough for people. You know, at Instawork, our pros, the people who work shifts via our platform, are suffering as a result of higher prices and higher interest rates. And a lot of them come to us and tell us that they are working because they need the extra money to make ends meet.
One of the reasons, one of the incentives, I guess, if you want to call it that the Fed would look at when it comes to raising these interest rates is that you try to cool the economy off a little bit and you try to curb hiring. But these jobs numbers that have come out continually show more and more gains, which if you're in power right now, you want to trumpet those numbers on the rooftops. But the question is, are there concerns about those numbers that continue to exceed expectations?
Well, the labor market looks very similar to what it looked like before the pandemic. We have almost identical unemployment rates, and the share of people who are employed looking over the whole population is pretty much identical to where it was in 2019. And yet, before the pandemic, we didn't have this high inflation. So you can have a labor market running hot this way without causing a lot of inflation. The question then becomes, looking at the inflation we have now, is it really related to the labor market, or is it related to forces that are beyond the Fed's control, like supply chain issues, commodity markets on a global level, housing shortages? Are these really things that the Fed's action is going to fix?
Instawork Chief Economist Altman joining us live on Fox 5. Good to see you again.
You too.
A reserve